This is Poland. The Polish economy has just had probably the best 20 years in its economic history, excluding 2020 of course, recording the fastest growth in Europe, being the only European economy to avoid a recession following the 2008 financial crisis, and outperforming other post-communist nations to become the first to reach developed status. However, it's fair to say that Poland often receives less attention than it deserves, despite regularly being touted as Europe's growth engine. This raises all sorts of questions, like how has Poland done so well? Why under 26-year-olds pay less income tax, and whether, as some have suggested, it can catch up with Germany's average income by 2040. To answer all of this, we first need to take a look at Poland's economic history. So, how has Poland's economic history shaped the country today? The nation, through the Poland-Lithuania Empire, used to be one of the largest countries in Europe, as this map shows. But whilst it possessed an income 60 to 70% of the Western European average, adjusted for purchasing power parity, this declined to around a third by 1989. In addition to being invaded frequently, particularly in the 20th century, one reason is that Poland, like a lot of Eastern Europe, missed out on rising trade following European contact with the Americas. Whilst this pushed Western economies to focus on trade-based comparative advantages, culminating in the Industrial Revolution, Poland remained largely focused on agriculture, something the very grandfather of economics, Adam Smith, noted in his book The Wealth of Nations. Fun fact: casting 18th century economics aside, Poland's steady economic performance over the last 20 years is linked to what happened up until 1989, communism. Like many parts of the world, Poland was a full-on communist nation following World War II, a period which saw rapid industrialization, expansion of social care, and access to higher education. Crucially, the centrally planned economy focused on public ownership, overseen by party officials in a system designed to hold real wages under control and restrict price increases. And, for a while at least, improvements to the lives of average citizens were made. But it's important to remember that the communist era wasn't one policy or one strategy. The economy over the 45-year period was constantly evolving, though not necessarily in the direction most economists or average citizens hoped for. The 1980s is often referred to as the lost decade in Poland and, to be honest, much of the former Eastern Bloc. Yet, even before communism officially ended, the country had begun to open up. The government passed laws to allow the creation of private businesses, which resulted in Poland possessing the largest private sector in Eastern Europe. Also, the country started to join the institutions which would prove so crucial to later success. For example, in 1986, Poland joined the World Bank and rejoined the IMF after leaving it in 1950 during the start of the Cold War, with the late 80s seeing the central bank given independence and its regional branches laying the foundations to later become commercial banks in their own right. And remember, all this happened in the twilight years of communism. Yet, the country's economic fortunes only really started to change after the economic revolution of 1989, and not even straight away, as we're about to find out. Why did Poland use shock therapy? In the immediate aftermath of communism, Poland elected a new pro-market government surrounded by a rapidly collapsing economy, with all the failing institutions and inefficiencies to address. Now, instead of trying to slowly turn its economy around through incremental market reforms, the country devised a bold plan to transition to a full-on market economy as quickly as possible, something overseen by Finance Minister Leszek Balcerowicz. Through the Balcerowicz Plan, which economists would go on to equate to an economic form of shock therapy. You see, the nation was struggling with hyperinflation of over 500% a year, so decisive action was deemed essential. The plan intended to stabilise the macroeconomy and liberalise business, creating the conditions necessary for a functioning market economy. This involved a range of strategies, such as largely abandoning fixed pricing, devaluing the currency, replacing state monopolies, stopping subsidies to inefficient organisations, and perhaps most importantly, encouraging the privatization of large state-owned enterprises. To be fair, this shock therapy was met with an initial backlash as economic output initially declined and unemployment rose. This was a monumental change in a way of life and remains a controversial topic, with critics arguing that the large-scale macro reforms weren't supported by enough microeconomic policies to help struggling businesses, particularly in the east of the country. However, its goals of bringing inflation under control and creating the conditions for private enterprise to grow were largely met, which no doubt helped Poland go on to record nearly 3 decades of unbroken growth. Now, for all of the rapid reforms brought in, privatization of the nation's crown jewels, its state-owned enterprises, was relatively slow. Poland didn't experience a wave of newly minted oligarchs like Russia did. It's fair to say though that there wasn't a grand plan to privatize slowly. This was largely the result of a number of factors, like limited know-how, outdated legislation, including a bankruptcy and commercial code dating from the 1930s, and a fear amongst managers that they'd be criminally liable for any mistakes in the privatization process. Ironically, by adopting a more gradual privatization process, intentionally or unintentionally, commentators note that a complete collapse of industry was avoided. In fact, in a lot of cases, state-owned enterprises dragged on unreformed for a number of years, which gave supporting services a chance to develop in order to assist in the eventual transition. Following the initial shock therapy, Poland turned its attention to its real aim, catching up with the West. A fundamental part of this centered around preparing the country for EU membership through developing strong institutions. And this is something Poland got right, improving its rule of law, property rights, and regulators, making conformity to EU standards a top priority. Now, just like many post-communist economies, labour reform was a key item on the agenda. Whereas previous policy had favoured collective wage bargaining, this was decentralised, and the role of government changed to act more as a referee between workers and employers, something which helped improve competitiveness. And these labour reforms have been beneficial to Poland's average wages, which have increased 5-fold since the late 90s, albeit from a low base. Yet, despite coming a long way, by the time Poland entered the EU in 2004, it was far from an economic utopia, even though it had grown so quickly from its low base. Unemployment had increased to over 19%, which is something which really helps put into context what happened next. Why was EU membership a game changer? Membership of the EU meant Poland became part of one of the most lucrative trading blocs in the world, where it could truly capitalise on its position between the economic powerhouse of Germany and the Eastern European market. Key to this success was ensuring it had the infrastructure in place to take advantage of its new position, something assisted greatly by access to the EU structural funds. These are funds all EU nations contribute to, which are then redistributed to help develop regions. Basically, a membership fee. Now, no EU member has received more money from these funds than Poland. And for context, net EU transfers amounted to more than 3% of GDP in 2018. And overall, this isn't money that it has wasted either, putting it to good use by upgrading and expanding its infrastructure. In fact, Poland has been so successful at capitalising on EU funds that it's anticipated to receive considerably less in the next EU budget, suggesting the strategy is at least working in Poland's case. EU membership is far more though than just EU funding. Free movement of goods and services have made Poland a great place for foreign companies to set up shop. The nation's comparatively lower wages, ease of access, and highly skilled workers make it an attractive proposition, going a long way to explaining why Poland performs so strongly in attracting foreign direct investment, ranking third in Europe after the UK and Russia, according to FDI Intelligence. Also, a separate 2013 study found that over a quarter of jobs in the private sector were based on foreign-owned companies, with foreign firms accounting for over half of the nation's goods exports, a loose indicator of how integrated the nation has become to global supply chains. However, EU movement isn't just about goods and services, it also involves people. The ability to move to a host of more developed markets and earn higher wages proved very attractive. By 2018, an estimated 2.5 million Poles were working abroad, having quite the economic impact. According to the Prime Minister, this has meant income per head is at least 5% lower as a result, despite seeing a substantial surge in remittances following easier movement. But, interestingly, just as Poland has seen high rates of emigration, 2018 marked the third consecutive year it topped the OECD for temporary labour migration, attracting over 1 million workers, issuing more visas to foreign workers than any other country in Europe, particularly to those from neighbouring Ukraine, which is unsurprising given the country's strong economic growth record, growing around 4% per year since joining the EU, 3 times the EU average. Taking a step back though, Poland still ranks 22nd in the EU for GDP per capita. However, it does have a plan to close the gap, with a report by the Warsaw School of Economics noting that if it could replicate its growth over the last 20 years, it could catch up with Germany's income per capita by 2040. An optimistic scenario as growth is set to trend down. What's Poland's plan to close the gap? Well, a great deal of effort has been placed on taking advantage of its large domestic consumer market. Domestic consumption comprises over 60% of GDP, exceeding the EU average, one based on a strong labour market and years of solid wage growth. However, the nation is under pressure from an ageing population. It's estimated that the workforce peaked in 2014. To help raise consumption, the government has brought in a generous payment system for families, known as Family 500 Plus. And this is significant, dramatically reducing extreme poverty, though critics suggest that this has led to lower female participation in the labour force. Now, as mentioned earlier, immigration is still a big issue. To help stop its young workers from leaving, Poland has abolished income tax up to an income cap for citizens under the age of 26, a more unique approach to a persistent problem, though perhaps its most interesting approach has been a strategy of increasing nationalisation. Despite undertaking a huge privatisation drive in the 90s, recently this has been reversed for certain sectors. For example, the second largest bank in Poland was renationalised, part of a wider trend with over half of banking shares believed to be publicly owned. This drive to nationalise is linked partly to reducing inequality, particularly in the East, which has historically suffered more from the fall of communism. And this goes to show how, despite all the progress, the economic scarring from communism and policies like shock therapy in its wake are still very much there. So overall, we've seen Poland's strong economic performance over the last 20 years was partly the result of starting from a low base, but also due to excellent reforms and taking full advantage of EU membership. The country has leveraged its comparative advantage in cheap labour within the single market. Yet, like so many other post-communist nations, it has had to deal with high levels of immigration, developing some unique strategies to address its looming demographic crisis. Whether Poland can achieve its aim of catching up with large Western economies is uncertain, but in 1989, few would have also predicted that Poland would have done so well so far. Now it's over to you. Do you think Poland's economic transformation deserves more recognition? Has Poland created a recipe for other economies to follow? This is a huge topic which we didn't get to cover in as much detail as we'd like to, such as political factors which were not the intended focus of the video. However, we'd be very interested in what your thoughts are in the comments below. If you enjoyed this video, consider giving us a like, and if you think we've earned it, subscribing. Also, don't forget to click the bell button to turn on future notifications. And as always, see you in the next video.